Walk us through your thinking now, and you lived through it when you did that merger back in the day. What was going on then, and to the extent you think that it mirrors where we are right now?
I think they're a little bit different. There's some parallels, but a little bit different. When we went public, AOL went public in 1992 as the first internet company to go public. Our market value was $70 million. 7 years later, it's $160 billion, the best performing stock of the decade. That early part of the decade, nobody knew or cared about the internet. Towards the end of the decade, everybody wanted to be part of the internet, and that drove that mania really around stocks. And when it broke, not only did AOL and Time Warner get hit, but most of those internet stocks dropped by 90% or more. Many went out of business. I don't think that's really what we're dealing with now, but I do think last year valuations did get a little frothy. We saw that through Revolution, particularly with our later stage growth funds. We pulled back on making new investments last year. We accelerated trying to monetize some of our public stakes in companies because valuations did just seem a little bit out of whack. And we do believe entry valuations matter. They're in venture capital. People talk about the power law. And if you invest in a company that ends up being super successful, it doesn't really matter what the entry valuation is. That is true in a very few number of cases. In most cases, the price you pay does matter. And so having that kind of discipline, I think we're seeing more of that now in the market than we saw last fall.
So we obviously had a steep increase in terms of prices, especially on the Nasdaq. We had obviously big tech was very successful during the pandemic. There were expectations that were even higher. We've seen a lot of that come off. I don't know how you think about, is that some kind of Alice in Wonderland situation, and whether you should even look at what those stock prices used to be in terms of a relative basis, or do you have to look pre-pandemic to even start to think about what fair value looks like? But then at the same time, you add on top of that the whole SPAC phenomenon, and that created a huge opportunity for lots of companies to effectively get public. That increased the price of a lot of private companies, which still, I would argue to you, haven't really been marked down fully. And how does that affect the overall marketplace?
Well, I think your assessment is generally fair. Valuations did, as I said, get high. SPACs drove some of that, but there are other factors as well. And I think it has been somewhat reset. It's fair. Not every company has raised a new round. Therefore, some of the current marks are probably based on older rounds that are probably still a little overvalued. So we'll see that over the next couple of quarters, probably that settle out a little bit more. But we have seen, and we're not really public market investors at Revolution, really focused on backing young companies, whether they be at the seed stage or the venture stage or the growth stage. And we have seen in the last few months a little bit of a pullback in terms of valuations. It's taking longer for rounds to get done. Companies have to be a little bit more thoughtful about the terms, not rush investors to make commitments. Investors are also being a little more cautious about the commitments they're making. So you're seeing a little bit of a slowing of the pacing, a little bit of a moderating of the valuations, which is healthy. As a result, I said last year, Revolution growth kind of pulled back. This year, we're quite active. We're seeing more opportunities because of the valuation reset in the private markets.